What's up, everybody? Welcome to the Mortgage Coach Friday Mastermind. For over 5 years, myself and Todd Bookspan have putting on this Friday Mastermind to help the mortgage coach community, the Win by Noon community, and anybody in mortgage that wants to follow along, just elevate, get better, get smarter. And in my opinion, in today's market, mortgage professionals and real estate professionals need more help than ever. So it's exciting. And not because you guys are doing anything wrong, but just the market is tough. And when it gets tough, we got to get going. So what's up, Todd?
Hey, not much. It's it's crazy. It's been over 5 years that we've been doing this, and it's times like this where I think it matters the most. I feel like we've had a great impact over the last 5 years on our communities. And I think now is, as you said, really super exciting time. I feel like there's a great opportunity for all of the mortgage coaches to continue to add tremendous value. And so that's kind of what I'm excited about today. Before we introduce the other Todd, of course, we got to bring on our third wheel, none other than Deborah Bird. What's up, Deborah?
Good morning. I'm excited to be here. I'm excited that Todd too is also on this call because we had a long visit, and this man is a content financial literacy junkie that we're about to unleash. If I could just take a USB and like plug it into his head and let it immediately go into mine. I'm excited to dissect everything that you have, all this years of content that we need. So I'm excited for this, and we can dive deeper into that. And let's go. Let's rock and roll.
All right,
it's Good
guys.
Friday too. Happy Good Friday, everybody.
Happy Good Friday. So nice shirt, by the way. The two of us did not sync up and coordinate this effort. Heads up to anyone who wants a no borrower left behind shirt. They're in the Win by Noon store. We'll put a link directly to these shirts. And that is part of the mission of Mortgage Coach and Sales Boomerang is to make sure that every family that qualifies for a home knows it. Like, we could proactively reach out to them. Every family that could move up or move down, let's make sure we get database alerts. Let's make sure we bring a total cost analysis. And one of the biggest missions of all of Mortgage Coach is just to help end the financial literacy crisis in America. So there is really no one better than Todd Ballenger. He is a longtime financial literacy innovator in the mortgage space. Someone that, since I founded Mortgage Coach, him and I have had a relationship and a partnership. He's a real live professor at the University of North Carolina. So he's one of those guys that knows this stuff and also knows how to teach this stuff in an incredibly instructional way. Now Todd and I, we wanted to do something a little different in this call, because we think as mortgage professionals, if we're going to teach financial literacy, we need to be financially literate. And so we're really going to approach this conversation as Todd giving a workshop for loan officers on how you can save money, how you can master money, how you can become more financially literate. And then, of course, there's going to be ideas where how do you take what you learned and apply it in the marketplace? He's going to give you some slides, some resources. And so, guys, this is an important call. Some of you, like if Dan Keller's watching this, you probably know all of this stuff, but you're going to get some reminders. The nerd, Denise, lives this stuff, but you're going to get reminders. So even though there may be things that you already know, maybe 80% of what we're going to share, it's going to be a great reminder. And then you're going to get it from a teacher delivered in a way that helps you teach and lead others. One last thought. I want to remind everybody that, big challenge to the mortgage coach community to get out into high schools and provide financial literacy to the next generation. So some of the slides, some of the tools that Todd's going to go through are great resources. They're great resources for you personally. They're great resources for your clients, and they're great resources for financial literacy training at high schools and colleges. So with that said, Todd Ballenger, what's up?
Hey, what's happening? Good to be here.
So for any new loan officer that hasn't heard me interview you and just doesn't know who you are, I want to know within just a minute, your backstory, and then talk about what you're doing right now, and then we'll get into the topic at hand.
Cool. Okay. I've been curious about money my whole life, so I'll start with that. The first time I ever saw an amortization table in the 7th grade, I was like, that's kind of cool. This guy sat down with me. It was a club where I taught tennis, and he was working for A.L. Williams. If you guys remember, that was the old insurance group. And he had this book. And I said, what are you reading? He showed me this AM table and compounding interest. And I was like, that's fascinating. I was mowing grass at the time. And I thought, man, that's really cool. And I just was always kind of curious. But I thought if I wanted to learn about money, I should become a financial advisor. So I became a financial advisor right out of college, got my securities, insurance, and real estate license, opened a shop called Capital Savings. And we did financial planning for 3-4 years. And I noticed that more people were making mistakes with their borrowing that could be more impactful. I could have a bigger impact on the liability side of the balance sheet. So I took my flag, left the financial planning world, went into the lending world. And then I've been in the lending world really since, 1998. I was a co-founder of mortgage.com and built a $1 billion plus, mortgage company over 7 states. And then I've been in and out of the mortgage business in all the different areas, from wholesale and retail and coaching and technology, you name it. So just fascinated with the lending industry, fascinated with money and finance. And so it's no better place to be, in my opinion.
So what was the relationship with Garth Graham? Did he come into mortgage.com before you, after you?
Same time. There were like 4 or 5 companies. So Garth had a partner who had a call center. I think it was called loanshop.com. They were one of the first online lenders. We had a retail mortgage company, and we had an online lender called PlanMax. It was lending through financial advisors exclusively with AIG and other groups. We had a group in California and Florida. There were 4 different companies that came together and created that whole monster back in 1999.
Yeah, no, and that's how we met, guys. I was an early adopter of technology, and when I heard like mortgage.com, I'm like, who got mortgage.com? And Todd and I, quickly became friends. And so I've always come from the mortgage world, like pure loan officer, mortgage guy that wants to put a little financial planning and financial literacy in it. And then Todd came from, hardcore financial planner who really wanted to help financial planners do a better job with liability management. And together, I think we've created a lot of leadership and a lot of value in the industry. So guys, hold on tight. This is not a time to multitask, whether you're watching the recording or not. Just pay attention, study what he's going to walk you through. And I want you to watch it personally, what can I learn from this? And then secondarily, how can I use this to teach and lead others? But this is a loan officer first training. So rock it out, Todd.
Cool. All right. And I will point out, this is just something you may have heard me say before, but when you're a financial advisor, you have very little access to financial information. I know that sounds counterintuitive, but most consumers give you bits and pieces to earn trust over time. As a lender, you're exposed to all their financial information from the very beginning, right? That's a classic loan application, is a financial statement. And if you just learn to spot and refer opportunities, you can take those opportunities and have a tremendous impact on people's wealth over time. Don't feel like you have to become a financial planner. I'm like, master your own financial literacy first. And if you do that, you'll become really good at what we'll say, just basically learning how to spot and refer opportunities. And you'll notice this is a course. We're just going to walk through some key concepts here. At the end, we'll tell you how you can get access to all this stuff. You can go through the entire course yourself. The entire course is an hour and a half. It's like watching a movie. You can go through all 9 modules, and you can share it with your friends. You can share it through, you can actually take the links and put them around your website. We'll give you access to how to do that. So you can kind of share the stuff. But you'll notice it's called CALM, and there's no better thing we need right now with all the chaos and volatility than CALM. But CALM stands for Cash and Liability Mastery. And the reason, and we'll talk more about that with the 3 buckets, but effectively, most people never get past their 30-day bucket, which is a cash bucket, meaning they have money coming in from their income, they have money going out for their expenses. If they have more month than they have money, there's really no wealth creation, right? They're always struggling in that first 30-day bucket. So you got to master cash. And then you traditionally need to manage your liabilities, your borrowing, because your largest single expense is around 42% nationally right now is housing, some housing related component. So again, we're in a place at the center of cash flow and housing and liability management where we are in our industry. But this course, we're going to hit some high spots and just some talking points that I think that, are interesting. And, understand what money is. So, we use money all the time, but if I said, what is money to you? It means a million different things to a million different people. But technically, it has to be a store of value, has to be a unit of account, and it has to be a medium of exchange. It has to meet those three criteria to be what we traditionally call money. So when I ask you about money, the technical definition is these three things. So anything that you have that stores value is acceptable as a unit of account, and people will take it from you in exchange from you. You can call that money, right? Be it seashells or rocks. Some people trade. My dad used to trade trains, right? With other people. That was a form of, it's a currency, but a very small community. We have more names for money than any other slang. So it's huge in our society. But when I say what is money universally, I'm going to go forward for a second. Most people talk about their money story. All right, I'm going to just kind of come down here for a minute and ask a question. What is your money story? This is probably, if you're going to start down a pathway of financial literacy, one of the first things I recommend that you do is sit down for a second and journal out on one sheet of paper, this is my money story, right? And there are levels of it. There's a street level, right? Just kind of like the very practical. How do I spend money on a daily basis? What do I value? When do I spend it? When am I not comfortable spending money? And then there's the neighborhood level. That's like thought, security, power. The city level is kind of this shared belief of money. Like that's your family, your tribe that you hang out with tends to have a similar thing. Like if you go out and spend $100, $200 on meals and you do that consistently, you probably hang out with a group of people that do that, right? That's part of that sort of cultural thing. And then the world level is the stuff you see on the news, CNBC, it's fiat currency conversations, it's the broader Bitcoin and all this stuff that's happening. But if you don't take a minute to understand your money story, you don't realize that you were programmed into your particular belief about money and how you value it and how you make decisions around it and how you choose to spend it and when you save it and all that kind of stuff. And again, we literally are surrounded by money in our careers, but we rarely stop to say, okay, what is money really? And what's my particular money story? And those things are really, really important for you to at least consider, because money has a big impact on quality of life, but only to a certain point. I mean, it phases out at about $105,000. And a lot of the people on this call make well beyond that on a regular basis. So again, understanding the tie, that role that money has in happiness and stuff is really important too. And we're going to get into the strategic kind of money dynamics today because that's fun. But the psychology is somewhat important as well, because it really tells you a lot about, again, your relationship to money and the genetic passing on of your story, because your money story is being passed to your kids and to their kids right on down the road. So I'll pause and take a breath here and there because I want you guys to jump in if you have questions or want to amplify anything.
Well, I mean, just the word, what's your money story, I think is pretty provocative and something that, when I heard you say it in our prep call, I was interested to hear how you were going to share it in this broader audience. And I can tell right now I'm going to schedule some self-time and just think about my money story and think about, what's the money story I'm passing on to my kids. And I love that word. I love that question. And I'm going to ponder that personally. Todd, anything come to mind that you want to call out or you want to ask Todd at this point? Ballenger? Todd Bookspan, anything you want to ask Todd Ballenger?
It's always funny because we're both Todd B's also, it's kind of like in grade school and there's two Todds, you at least, went by the first initial, but I guess we're just books. I can be Bookspan today. He can be Todd since he's our,
okay.
He's
so
our
we're going to go,
guest.
your Bookspan today and Ballenger is Todd.
Well, no, I mean, I feel like I love the story of where we're going. And I like, you called out, Dave, kind of what I was thinking is really, I look at my kids and their relationship to money. And I think it's just why it's so important when we have, you on, Todd, is that you just give a different perspective to all of us when it comes to financial literacy. I think we're always thinking it from, the world that we live in, our personal sphere and our clients that we're giving advice to. But I think that you just take it to a whole nother level. And I think just really where you're starting today is just what we all need. So yeah, I would say just keep on rolling.
Well, cool. Before he keeps on rolling, I do want, Deborah, anything you want to call out? Because I mean, I was also thinking of just social media posts, where there's a couple social media posts to put around social money and even a question to ask. But Deborah, anything you want to call out or anyone with any ideas?
That's exactly what we do. And when we create content to share, I think it's important to realize sometimes our money story or the financial literacy that we learn in order to, impact more the audience, sometimes they don't always accept it because maybe they were taught something else or their city level view, um, you know, was passed down and they have different conditioning. So that's why I feel like why it's so important. You have to be sharing financial literacy and be financially literate and consistently make content, which we can help you do, so that when that consistency is done, you can help create some of those shifts so that perhaps the money story that needs to be maybe relearned or unlearned to help people. How else are you going to open that conversation if you're not? And I think what I hear often is loan officers say, well, what if I say something wrong? Or what if I don't want to look like I'm a financial advisor. You've got to get past that and at least create content to start conversations and then use that as leverage to just take the dialogue to go deeper. It doesn't mean you're portraying yourself as a financial advisor. And that's what I love about, Todd. I was looking at some of the stuff in your certified liability advisor group on Facebook, just the content you create that would be so easy to take the time to learn. Like if you took 30 minutes a day to read about financial literacy and think, how could I share this that would impact someone in my sphere and start with social? Why wouldn't you do that?
Yeah.
And one more thing, Todd, before I hand it back to you, because I also, when I think of money story, as a loan officer, most consumers in their money story don't think of their mortgage or their liabilities as strategic. That like the general public doesn't do that. So I just want to, within the context of this money story conversation, realize that, you've got consumers that don't have the right narrative, and we need to change their mortgage story, how they look at liabilities within the context of the money story. So anyways, Todd, keep it rolling. I know you got a lot of content, but I just think it is a powerful concept and a lot ties into it.
Yeah. And something I thought of as you guys were talking, a lot of parents, especially successful parents that I've talked to over the years, really struggle because if they've done well, they want to leave their kids money. But, and it's another analogy I've always loved, but I mean, if you could leave your kids Tiger Woods golf clubs or his golf swing, what would you want them to inherit? Right. And it's the same. If you leave them money, it's typically gone. I mean, there are a lot of studies that show how quickly wealth dissipates if the children receive wealth, but they don't receive the literacy of how that money was earned. The Rockefellers and the Rothschilds had this whole thing that's called a bank, where they put their money into a bank and the kids had to exchange knowledge to access the money. And then they had to show what they learned from it. And it was all part of that perpetual sort of, again, giving and re-giving, because you got to pay this stuff forward. If you're really successful and you leave your kids money and you're too busy to teach them about money, that money's going to be gone very quickly after you are. They're not going to be able to do anything with it. This factors of production, I was going to skip this, but it's so interesting. There are 4 ways to make money: land, labor, entrepreneurship, and capital. And most people make their money through labor. That's human beings doing work. Entrepreneurship is human beings doing work plus risk. There's an element of risk in entrepreneurship that you don't have with traditional labor. But this is really what we're getting at, is that once you have more money than you have month, you're in a position to have capital work for you. That's when money earns money. That's true, like wealth creation over time. So when you get to, we're in a really weird place too, where, every year we live, we get 4 months free just because of the current medical innovations. So think about that. If you can stay alive, I forgot who it was, one of the financial guys said, if I can just stay alive long enough to stay alive forever, that's an opportunity potentially, right? So that longevity is growing. The idea of retiring at 65, if you're going to live to 125, is kind of weird, isn't it? So the whole notion of retirement is getting shifted. Why would you retire from something you enjoy? That's that's part of the psychological concept of money. Dave clearly loves what he does. Why would he retire from it, right? And if you don't retire from it, you're probably going to keep making money anyway, because people pay you when you do things that help them. But this lifespan keeps getting longer and longer, which means you have more time for money to compound, but you also have more money that you're going to need over time. And most people make millions of dollars in their lifetime. If you just take your income times how long you think you'll be earning, if it's just 45 years, 20 to 65, and you make an average of 100,000, that means you start at 40 or 50 and you end up around 200 when maybe you retire. That's $4 or $5 million. We're all millionaires. It's just a question of how much do we keep over that time period of work? How much do we put to work for us? So, this is the simplest way. When I first sat down with my kids to talk a little bit about, money and spending, we use this in our mentor coaching thing, and it's really a simple system. But the idea is that this is the bucket that most people struggle with. This is where, if you have more month than money, you're stuck in this 30-day cycle where you don't, and then you have to borrow to make up the difference. So you want to fill up your first 30-day bucket with 30 days worth of cash. And then your 90-day bucket can be 90 days of cash. And that really gives you, if you look historically at losing a job, all these major life events, the average recovery time is less than 90 days. So people worry about stuff happening, but if you lost your job and you were in a traditional labor type thing, you can find a new job within a couple months. So as long as you have anywhere from 30 to 120 days of cash, a cash equivalence, you're okay, right? The rest of that money can then go into that third bucket, that investing bucket. And that can be any investing platform where the capital earns capital for you. That's where the money is earning interest, right? And I know it's so simple, but then I've had people that started doing this, and they're just like, you set up a checking account, and you have another checking account, and that's your two buckets, and then you set up a Schwab or an investment type account for your third bucket. And when those first two buckets are full, everything gets poured into that other bucket, and you can pour it back, right? But if you make $10,000 a month, you want $10,000 in this bucket, you want $30,000 in this bucket, you got $40,000 in cash equivalents, and everything else goes here. And with these two, it's all about liquidity. It's just having access, use, and control when you need the money. This bucket's about long-term growth, rate of return, rule of 72, doubling every 7 to 10 years. It's all about building that and letting that money make money for you over time. If you're short here, an air conditioner breaks down, or something happens here, you lose your job, you can pour from this bucket back into this one. You can pour from this bucket back in and fill up here until you get it right sized, and then you're back pouring your buckets one after the other. So my kids got their allowance. They would set a budget, $200 for their monthly spending. $200 was their first 30-day bucket. Once they had more than $200, money from Christmas or whatever, they asked themselves, is my $600 bucket full? Right? Because that's 3 times what they might need. And that's $800 to a high school kid. That's a lot of money. Everything beyond that, hey, it was going into, Bitcoin or some kind of savings or investment account just to see and watch their face go, gosh, I made $4.92 this month on my interest account, right? That's that money that's compounding when they're not having to babysit or do something else. But it works the same at scale. If this is $100,000, this is $300,000, $400,000 is plenty of cash. Everything else, you can take risk. You can let it kind of go out there and be there for the long haul. And this is all in the course, but just kind of takes you through examples. It's really simple, but it's not easy because most wealth creation has very little to do with making money, because MC Hammer made a lot of money. There are a lot of people that made a lot of money and have nothing. They're living on the street. It's simple, but not easy. It's all about discipline. If you want to have $1 million, you only need to save $100 a month to have $1 million when you retire, right? If you want $3 million, it's about $200 a month. Most of us can handle $200 a month average over our lifetime. That's a simple decision, but it's not easy. I'd always want to go here, but I know this is probably a little bit better for me. So it really comes down to discipline. And financial freedom, as we think of it, is really simple. It's the point where your savings, this little red line, is throwing off more income than you're spending. And what is typically the case is we make more as we get older, and we tend to try to then spend more. And that's okay if it's really fulfilling. But for most people, you get to a point of diminishing returns where the more you make, you try to spend it, and it just becomes more noise, more stuff you got to maintain, more everything else. And in reality, as you get older and wiser, you know what you like and what you don't like. So you actually can make more and spend less. And you can get to a point very early in your life. And this whole FIRE mindset and stuff that you see today is all about if I can figure out what I really like and what I really want to spend money on, and I can save very aggressively early, I can get to a point where that passive income is such that I'm financially free. And that doesn't mean retire. It just means that work is optional. And work optional is very different. There's a certain freedom coming from working when you just know it's fun. But a lot of this stuff, compound interest, this is one of the things that I've always been fascinated with is if you say to someone, how much do you think you'll make over your lifetime? And they say, I don't know, $3 million. And I say, how much do you want to save for retirement? They'll say $1 million. Now, these numbers are just what? They're kind of pulling them out of the air, right? But the concept is if I make 3 million and save $1 million, what's happening in your head mathematically? Todd, when you say, all right, I'm going to make $3 million in my lifetime and I want to save $1 million of that. What do you kind of feel like you have to live off?
Not a whole lot.
Yeah. You think I got 2 million that I could live off of if I'm going to save $1 million. And that's a misunderstanding because to get to 1.5 million or close to $1 million, which, $1,200,000 is at roughly 10%, which is where the market has been for the last 30 years. That's $100 a month over your career. $100 a month over 45 years is $54,100. That makes sense. It's like to get to $1 million, if I'm going to make 3 and I'm going to save $1 million, mine says, I only leaves me $2 million. That stinks. No, that leaves you everything but $54,100, because if you just put $100 a month away over that career, you'll have over $1 million, and at $200 a month, over $3 million. So that's 108,000. So again, what's 108,000 on a $3 million, lifetime income?
That sounds pretty doable. I think the catch 22 for people is they don't start early enough. And then ultimately, they get distracted, they pull the money out because something goes wrong and they don't get it put back in. And it seems to me like I keep hearing that 10 million is the new 1 million in savings. What's your thoughts?
Yeah. Well, yeah. When you look at, what they call a safe withdrawal rate, it's around 4%. And the reason they say that is if you run Monte Carlo simulations and stuff, if you take 4% of your capital and spend it annually, there's like no period in time where you've ever run out of money, no matter how bad the market goes up and down. So $10 million at 4% is $400,000 a year in income, right? And, so if you felt like, okay, in retirement, and we have a calculator for this that we'll give you guys access to that you can play around with at the end. But if you really think I need $400,000, you're going to have to save a pretty big number. You could probably get away with 5% on something that big because you got more, room. But if you think I need 64,000 a year in retirement, you're not going to have as much room to adjust, your spending. But certainly inflation is sort of creating a little bit of fear out there in the marketplace today, and it's causing people to accelerate some of their expectations. But again, we're living longer. You can work longer. You're going to be healthier. There are a lot of different, gating factors and levers that you can play with when it comes to this retirement. But retirement is something sold by mutual fund companies, right? Because you got to want to retire to have a big pot of money anyway. I mean, there's a certain security you want to have financially, but I think as much of this is not just saving money and financially, improving your well-being, but it's also getting into things that you love doing or finding a way that you love doing it so that you don't want to stop, because you don't have to access that pot of money if you really enjoy what you're doing. 72, the rule of 72, I won't spend a lot of time on it because it's just been around and most people know conceptually what it is, but you just divide the rate of return by 72, and that's how long it takes for your money to double. So historically, we've been averaging over 10% for the last 30 years in the stock market. And that means your money's doubling about every 7.2 years. And that's really important because the first million, when you're saving, let's say you're saving $250 a month and you're getting a 10% return, it means it takes you 35 years, about the length of a mortgage, to get to the first million. But if you already had $1 million and you started saving, that $250 a month doubles in 6.8 years. And if you already had 2 million, you get to the next million in 4 years. And that's the magic of compound interest. That's when people have money, it's a lot easier to make money, because when we go back to the 4 factors of labor, that capital is making money for you at that point. Here, you're just starting out with just $250 a month, meaning your first deposit's $250. But you start early enough, and this is an example I put in one of the Facebook things. This is a time value thing you're talking about, Todd, is, Billy puts away 15,000 when he's 15, stops saving at 19, never saves another dime from his lawn mowing. He'll have 1.6 million at age 65. His sister Susan starts the year he stops, invests, as you can see, $24,000 over 7 years. She'll have 1.5 million. Kim, the third sister, starts when Susan stops, saves the rest of her life, and has 1.3 million. So that's the time value of money is astonishing, and this is where, we were talking about this the other day with reverse mortgages. One of the coolest things that a grandparent could do if they really wanted to help their kids is do a reverse mortgage and seed up, all their grandkids with 50 or 100 grand, while they're 10, 12, 15 years old, and just never touch it. Because you're basically, if they left it there for 30 years, guaranteeing them millions of dollars in their future, right? Whether they work or not. Because if you just put a lump sum, this is 15,000 over 5 years. We'll put $50,000 in the 15-year-old's graduation, high school graduation account, pulling out of reverse from the grandparents, which doesn't really cost them anything. It's a little inheritance advance. And then this number becomes exponentially higher.
Hey, Todd, can I pause you? Can I pause you right there?
Yeah.
So go back up to those. And I mean, first of all, we've seen this before. Like, this is not the first time I haven't seen this particular slide before, other than you sent it to me last night in prep for today's call. But this is could be such a powerful social media post. Did you know? And while I think a lot of people, they did know this, they heard it before, but guys, you can't hear this enough. And it's such a great reminder. Deborah, any thoughts come to mind on all the different micro content that could be created from this, and all the TikTok videos, and how this would integrate into a mortgage coach conversation? Anything come to mind on your part? We don't hear you if you're talking, Deborah.
I was going to say there's so many, and I can remember we made one recently about, I think it was the day a child is born. If parents knew, which I feel like every new parent should know this. I wish I would have known this at the time. If you put $2,600 aside, then by the time they were ready to retire, they would have $1 million in the bank. I don't remember the exact numbers, Todd, you may know it, but it's like if people just knew this, because they don't understand how money compounds, and you do need to see the numbers, because I think, again, it takes consistent messaging to help them realize, oh, okay, is it really that simple? I could do this, just at the time of birth, and have a perfect strategy for them that they wouldn't have to worry about. But I would say, just from analytics, the types of posts we make that always get the most views, engagement, likes, comments, is anytime it's about budgeting, when it's about finance, or credit. Now, granted, it's a little bit broader of a sphere, so people could be shopping for a car and they want to know how to maybe improve their credit, but it also reveals that's what's on the minds of the consumers. That's what they want to learn more about. They're hungry for it, and especially millennials and Gen Zs. I think people forget they were kids during the housing crash, so their parents were starting some of these conversations with them. They don't have any money to save because they have the highest amount of student loan debt. But imagine how we could change the world if we started packaging these messages where every advisor on this call basically hired us and let us do it for them. But this is what we love to do. This is what our goal is at Plug and Play, is to help transform the lives through the vessels of the advisors who care enough to, be the most valuable, trusted advisor for that family's team.
So I passionately believe that mortgage professionals are the single most valuable advisors to consumers. For what Todd said, we have more data. We have more data than CPAs, more data than financial planners, more data than all of those guys combined. When we take an app, we've got liabilities and assets. And also, we're talking to a lot of folks. I mean, there's 29 million or 49 million Americans that use a mortgage to finance a home. So if we, as mortgage professionals, first of all, deliver a little financial literacy to every consumer that we serve, and then also, guys, we're great. We're good on social media as an industry. like, I think the mortgage industry is better on social media than a lot of other industries. So if you started taking some of this content and putting your personality behind it, localizing it, personalizing it, and sharing it, guys, we can really put a dent in financial literacy in America. And I think there's probably a half a dozen micro lessons that Todd's gone through, but this most recent one, I can't remember the word you used, but it's mind-boggling, this story. So
Hey,
I
Jake,
just
you
want
know
to
who it
appreciate you doing
reminds? The TCA that first comes to mind is the one, I think it was Drake, who helped the doctor when he showed the reinvestment strategy. You remember that
Oh yeah,
TCA?
oh yeah, oh yeah.
And there was another one, I can't remember who it was now, but he showed, instead of paying cash for a property, what if you took the same amount of money and instead bought 3 properties and used the TCA to show how it's just a different strategy using the same amount of money, but the end result was drastically different.
Yeah.
So
Well, there's-
that's what I mean by the storytelling and then you pull in the emotional connection of how you are literally, every 1003 is an opportunity to transform someone's life. Like that doctor who was going to do a rate and term refi with a bank. Thank God Sales Boomerang gave that alert so that Drake could immediately intersect that and do the cash out refinance instead. And just, again, Drake had to put in the work and the grit to study financial literacy and be equipped and take the time to learn Mortgage Coach to help give clarity and transparency, which makes it easier for clients to make decisions with the platform. And I think that's the biggest goal, is how do we make these decisions easier? Which I love the digital side of it, where you can literally take an app in the comforts of your own home and rewatch, video tutorials often as you need to. But that's the goal. I mean, that's why we're all doing this. And that's how you're going to really create that brand of a differentiator between the robots. Otherwise, if it's just about rate and fees, then you have no brand. Why would someone pay more to do business with you? How is your advice transforming and helping them long term?
no doubt. And by the way, Todd, could you stop sharing real quick?
Sure.
I want to share something, and Todd, Bookspan, jump in with anything, but I did want to show a TCA I received yesterday, and this is a mutual client of Mortgage Coach and Win by Noon, Michelle
And me.
Mason. And you?
And she's a rock star. Yeah.
Oh, right on, right on. So she's in Mississippi, Oxford, Mississippi, and every family she serves gets total cost analysis. She does pretty good production, right, Todd? Like, what is Michelle's production?
She averages like over 30 loans a month. She's awesome.
Yeah. So here's in Oxford, Mississippi, and every family is getting a total cost analysis. And she sent me this the other day, and I'm not going to show this to say, hey, she did a little bit of a Dave Ramsey versus Warren Buffett TCA, where she said, hey, Dave said, pay cash or do a 15-year loan. And she said, well, maybe Warren Buffett would say, put 20% down and invest the difference. And so she did a little play on this financial literacy, and look at the net worth here, guys, with these two different scenarios. Now, again, the biggest issue is where Dave Ramsey, wins so often, is the issue is not intellect or money, it's discipline. And most people, they're gonna spend the money. They're not gonna follow this plan. But if I was teaching if I was the financial planning teacher, teaching financial literacy at high school, I'd be teaching Dave Ramsey principles. I'd be teaching Warren Buffett and Rick Edelman. By the way, I'm interviewing Rick Edelman next year, guys, or excuse me, next week.
Blast from the past.
Yeah, no,
I've heard that name in a long time.
He's
got a mortgage.
He's got a new book coming out, and he's passionate about it, and I'm gonna be interviewing him. But I want to show that as an experience, that taking different philosophies and then putting those into a total cost analysis, it's local, it's personal, and then guys, it can be adjusted. You can start playing with that. So that should be part of your education process or part of your education toolkit. Any comments on that, TCA, Todd?
Bookspan or Ballenger?
You're Todd on Bookspan today.
Yeah,
yeah. Okay, I'm sorry. Yeah. So no, I love it, and you spot on. I'm not a big Ramsey, fan in that everything, is discipline oriented. But if you really have no discipline, yes, I mean, putting the money in your house is earning you a 2 or 3% return if it's keeping you from spending it. But if you have any kind of self-awareness or self-direction, you're almost always going to be much better, having more liquidity, and again, forget about return, just liquidity. I mean, the problem with his core philosophy is put everything in the house. Well, what happens when you lose your job? What happens when, this and that? Think about all the life events that come along. You can't access that wealth. It's illiquid to you. And that's the downside. A lot of people think about the return, but there's also the liquidity component that really needs to be concerned or considered. And Dave,
So, Michelle, thank you for that, TCA.
Yeah,
I hope you listen to this, but always appreciate you and the value you bring to the community.
And Dave, you keep talking about micro lessons. I mean, I love that because there's 10 micro lessons in most of these slides. But one fun one I'll share with you is what would you pay for a 15% off coupon on your mortgage, Dave?
I don't know, more than 15% off.
Say it's a $300,000 mortgage, and I said I got a 15% off coupon. What would you pay for that?
I mean, my mind isn't working fast.
No, it's
$70,000. $70,000.
So it's a fun thing that you can do. This is using the compound interest we just talked about in a different way. You have a mortgage holiday, we used to call it, in the book, when people have their close on their mortgage and the payment's not due, right? So we would say for 15% off on your mortgage, here's all you got to do on that first payment that's actually due. You got a month off anyway, make 2 payments. Run the AM table. If they make 2 payments on their first mortgage and nothing else, it'll knock 3.5 to 4 years off their mortgage and save them about 14 to 15% of their interest.
Wow.
Right. So these could be fun ways that you can use compounding to say, I don't believe the house is the best thing for you to, the best place for your money. But if you got a free month in here and you want to do something cool, take 4 or 5 years off your mortgage, just make an extra payment up front. And some people would say, can I make a $5,000 payment? I'm like, yep. If you want to do that one time, just do it right now, because the compounding is going to work in the same way. A $2,000 mortgage payment over 30 years would knock over $40,000 of interest off that mortgage loan over that time period. Wow. So again, that's a pretty good return, at least, again, a psychological financial return, and that could be a cool social media thing to play around with.
And I want to remind folks, I'm going to try to pull it up while we're talking. We've got the, if you just took what the $5 a day you spend on Starbucks and applied that to your principal, I'll show you a cool infographic we have in our Facebook group. So check it out. Anyways, keep it rocking, Todd. We got 14 minutes left.
No, we're gonna crank.
And I want to make sure you get through all this.
Yeah, last double is so important conceptually. And this is not only the power of starting early, but this is a really important thing to understand when you think about putting wealth inside the house, because once that money's inside the house, it's earning whatever your interest rate is on that mortgage at that time. And again, net of inflation, which we are in a negative environment right now. But this last double is important, right? So if you had $100,000 and you started at age 20, say that your grandparent did a reverse mortgage, gave each of the kids $100,000, stuck it in an account. At age 62, they'd have $6.4 million. Why? Because the rule of 72 says every 7 years, your money should double. So 100 becomes 200, 200 becomes 400, 400 becomes 800, 800, 1.6, 1.6 becomes 3.2, 6.4 is the last double. Now, where this is really, mind-blowing is if this person waited 7 years to do this same thing, their last double is the 3.2. So the difference between this last double here is $3.2 million, because you're doubling each year based on that starting point. And that's where anytime you can accelerate money to younger generations in a way, just setting it up, like you said, for the baby or whatever, and letting those doubles happen. But there's a lot of there's 20 micro lessons in here with cash out refinances and all kinds of other things you can share with people. We teach a lot of this in the CL stuff to help them understand the time value and concept of money and borrowing.
Just we real quick take a break and let people know where they can access this and how they can purchase and to get access to this content, Todd.
Sure. Well, they can get access to all this for free as a student. Just go to knife.org, NIOFE.org. That's NIOFE.org, and go click on education, and you'll see the Calm course. You've got all the videos. You've got access to some of our materials there. Go through and watch this stuff, and play around with it. If you're really interested in teaching it and you want to teach it, then just reach out to me and let me know that's something you want to do. And we allow our CLA graduates to access all the stuff for free and teach it. We have people teaching realtor offices right now. They're going branch to branch. We have people in high schools and colleges. We have people going to businesses. We've done this whole campaign now where we're sending stuff out to businesses, offering a 90-minute lunch and learn or afternoon social. We come in and provide the 90-minute workshop. So you get the calm right in your place of work, and you're bringing the financial, stuff right to that end consumer. And you don't have to be a teacher. You can just be a facilitator. That's the beauty. You just walk through the slides, explain some of the core concepts, and then you can direct them. They can watch the videos when they have time and they want to go through some of this stuff. But
I love it. I think most people here are thinking, gosh, we wish we would have saved for our kids earlier. And I do feel pretty good since my kids, all three of them, just put money in their Roth IRAs yesterday.
that's fantastic.
That made me feel good, but gosh, I just love seeing all this.
Yeah. I mean, you can hire your kid, like, hire my kids, put them on W-2 and then get IRAs. They set up IRAs when they're 12, 13, and they can put their Christmas money in it and stuff like that. We're all in the debt business. There's good debt, there's bad debt. There are only two types of good debt in my mind. That's student loan debt. If you have to borrow for student loans, you're investing in an appreciating asset. That's yourself. And then mortgage debt, because traditionally mortgages always appreciate over time. And that's an important concept to understand. Otherwise, your debt's going to be high interest rate. You're buying depreciating assets and
Hey, stop real quick. Go back up.
Yes, sir.
Just gotta show a little TCA love there, guys.
Yeah, man, you got it.
I'm a big fan of using slides to tell stories, especially when you're in a teachable format. And the only push I would put to everyone, if you're doing training, whether it's at a high school or whether it's with realtors or with consumers, maybe you have the slide as a prop to talk about the TCA, but you want to go to the link, because what you want to do is you want to get them to want to get a customized, localized link from you. So if you were teaching rent versus own, you would say, hey, you might tee it up with the slide, have a takeaway, but then, you want to show them that, hey, this is an interactive link. And if you'd like me to do a rent versus own for you, I can make your own personalized, localized digital link. And I can do it in a few minutes. So always, when it comes to lead gen, and you're doing teaching and training, and even with high school kids, you want them to get the link so that they can talk about it with their parents, and you want the teachers to get the link. So again, it has to be a total cost analysis that's relevant to the lesson. It might be that Dave Ramsey versus Warren Buffett TCA. It might be a cost of waiting, that, hey, people that wait when rates go up, what does that cost them? Let's net it out. The math doesn't lie. Anyways, Todd, we got 10 more minutes. What do you want to make sure we hit?
And I'm going to amplify. So when you say rent versus own, that means something to people on this call, but to a consumer, what I love to do is to think about this in really practical terms, and for you guys to learn how to frame that. Like, you can say rent versus own, but I would say, would you agree it costs money to live indoors?
Yes.
Okay. And if it costs money to live indoors, you're going to pay either your mortgage or a landlord's mortgage. Right? Because that's what rent is. Rent, you're paying the landlord's mortgage. Buying a home, you're buying your own. Which of those would you prefer? Would you rather, because if you get into rent, you can get people off. So really, you're always paying a mortgage if you want to live indoors, and it costs money to live indoors. So if it costs money to live indoors and you're always going to pay a mortgage, you want to pay yours or your landlord's. Now let's look at what is the lowest cost of living indoors over your lifetime. Right? And then you do the analysis, because what you're really doing is you're framing for them that it costs money to live inside. You're always going to pay a mortgage. What we're really trying to do together is figure out what's the lowest cost of ownership to do something that I have to do over the next 30, 40, 50, 60 years. And that difference in pre-framing really helps people to then receive the value of the TCA and the other materials that you're providing. And it's subtle, but very impactful over time. If you'll learn how to pre-frame these conversations to set the stage, so someone becomes very receptive to what you're about to show them, you'll actually get more accomplished in your actual conversations. Does that make sense?
So guys, that was a huge micro lesson and message for all of us. And I always say the words that you say before you show the total cost analysis matter the most, and Renee Rodriguez talks about the frame. The frame is more valuable than the story, because if you just tell the story without a frame, it doesn't connect emotionally. It doesn't connect intellectually. I think it was you, Todd, many years ago, you taught me this lesson that if you ask a question rather than state like a fact, they're like, what was it like?
People appreciate what they discover.
Yeah, but what's the percentage in terms of, you gave me a number, like they're X% more likely to retain that information if you ask a question.
Absolutely. Yeah. I know exactly what we're talking about. I can't remember the percentage right now. I'd make one up and it would sound believable, but I can't remember it, but I know exactly what you're talking about. It's just when they have to reframe, they're reframing in their own mind what you're asking them in a way that it becomes theirs and not yours. And in doing that, they retain what's happening because they appreciate what they discover. They appreciate what they say more than what you say. So anytime you can reflect back to someone in the form of a question, like I said, we can do a rent versus own. I can say, do you realize you're going to pay money to live indoors? Yes, I do. That's them stating what? Yes, I do realize that. It's totally a different thing. And then they start to engage with you in a completely different way. That's why people love to, again, they love to discover. They're discovering as they speak things that they haven't spoken before, out loud.
Yeah. And authorship is ownership. When they author those things,
Absolutely.
They own those things. So anyways, keep it rolling, bro.
Absolutely, because the second they author it, they start looking for proof to validate that belief. So there's credit stuff in here, and this is a fun conversation because everyone's playing the game of credit whether they realize or not. And what we're really doing, again, is taking them through the basics. You're not trying to, we call it cash and liability mastery. Mastery takes time. What you're doing is creating awareness, helping them to realize that, again, what is a credit score about? It's about the odds of default. And why would you want to have a good credit score? Because you want to be a really low odd of defaulting to that lender. And because you're a low odd of defaulting, they'll give you a low interest rate risk. If you just say have a good credit score, they don't know how to tie that credit score to what does that really mean? Well, think about it. If you had an 8-1 odd of defaulting, we're going to have to charge you a lot of interest for that. You don't want to be that person. Get up here where your odds are really low. They're going to treat you as a valuable customer. It's going to have an impact on your borrowing, your investments, your utilities, your credibility and stuff. And
Hey, Todd, I'm looking at this and I have the whole deck and there is so much gold here. Actually, stop. Because what I want to do, go ahead and stop sharing your screen.
Okay.
I want to have a part 2 to this where we refresh some of this stuff and then 2, we go through the rest of it. Guys, assuming that you in the mortgage coach community, you want more of this, like, do you want the whole overview and class on this? Is there, and Todd's committed to, creating more content in the mortgage coach community. If you haven't noticed, he's been posting key insights, just really valuable insights that are clever, memorable, useful in the process of advising people. I think I created a topic and I think it's called Key Insights, or maybe it's just called Insights, but check it out. I'm tagging all those that Todd puts in there. And other insights, there's other slides that people have shared that are real valuable. So just make a note. They actually have a topic, a theme within our group. So I want to make sure, I think you covered where people can get this, and we've got a link down below. I also know that you do a training, a certified liability advisor.
Yeah.
Before we run out of time, I just want to make sure people know about where to get signed up to be. Like, guys, this is a college level class that takes, 6 weeks. How many weeks is it? 12 weeks?
It's up to you. You can go as fast as you want, but it's about 30 hours of content. And it's really trying to take, again, these concepts and ideas and saying, master them yourself in a way that really you can call yourself a certified liability advisor. That it's a different framework and a mindset. It's where we started from. We created that designation out of our work way back in the day. And you go to Bar Smart University and learn more about that. And it's just a lot of great content and conversations and ways to pre-frame and set this stuff up with your clients, and we teach you a lot about building relationships with financial advisors. So you can do it for yourself, but for building out a new channel of business, you'll start to see why you get more and more comfortable calling on advisors, because this is the world they live in at a certain level. And it just gives you a vocabulary to go in and talk to them.
And isn't there a mortgage coach discount? Is there a discount for mortgage coaches?
Absolutely. We can post a coupon code or something, the 5%, 15% off your 30-year mortgage, but we'll put a coupon code in there.
Okay. And what is the cost of it?
It's $14.99 is the cost for the whole course, all the materials, everything. And then we do like right now, we have a Facebook coaching call for all of our current students. So we do a Friday coaching call for an hour or two, where we talk through how you're implementing and engaging all of this stuff in your class.
Good. So guys, check it out. Go to the link he said, Borrow Smart University. Robert just put a link in show notes. If you're watching this in YouTube, there'll be links to everything we've discussed. Todd, Bookspan.
Okay.
I want to make sure Mr. Win by Noon helps wrap a bow around this, makes it actionable. And if he has questions, Todd, what are your thoughts at this point? Our Bookspan.
Well, I know we have to have a rule. I got to wear a different shirt with my name on it or something when we have a Todd on here. Thankfully, there's not too many smart Todds like me and Todd Ballenger. I think the key here is that you've got a gift, right? Every time Todd comes on, he shares content with all of you that you can go out and share. The number one conversation that you all have with me is, I don't know what to say. And Todd not only has a free course that you can, follow and learn so that you can actually teach the information with his permission. I would really encourage you to take a look at the Borrow Smart University, because I've been through part of the course. I haven't done it all yet, full disclosure, but it's amazing content. And really in the end, we keep talking about financial literacy as really the secret sauce of 2022. I mean, kind of, it's always been the secret sauce, but more important now than ever. And this is the easy button for you. This is the content. This is, Todd gives you the script of what to do and how to do it. And I just think it's a great opportunity for you all. So, of course, my action plan is to go back, rewatch this when it's posted on YouTube, and just get out there and start teaching, right? Take the baby steps. And then the last thing I would say is, if you're a parent, make sure you're doing this for your kids. Or you're a grandparent, be doing it for your grandkids, because it certainly has, I know I've made some great decisions in the past, and I look at this and realize I missed a lot of great opportunities. So I'm super grateful, Todd, for you sharing all this with us.
Yeah. Thanks for having me. I appreciate it.
And a couple of thoughts I want to share, guys. I want you as a mortgage professional, as a person, to, look inside first. What is my money story? Do I understand these principles? Am I living these principles? Have I taught my kids these principles? And if not, how am I going to teach my kids these principles? So, I am just dedicated to everyone that listens to the Mortgage Coach YouTube channel, and every loan officer is a mortgage coach. And, I want you to obviously use a total cost analysis for every consumer, but I want you to be more financially healthy yourselves. And I want you to help change the story in America. Like, I believe that as mortgage professionals, through social media, through the consultations we have with clients, guys, we can make a massive difference. And then if you add on to that, that folks are going out and doing volunteer education, partner with a financial planner and go to a high school. I love what what's Mike's last name? Garrett. Mike Garrett at Movement. Listen to the interviews I've done with him. He's doing amazing things. And we have a lot of mortgage coaches that are getting out. Dan Keller is doing, regular trainings, and he's, does it at a college level. Mr. Ballenger, any closing thoughts before we wrap a bow around today?
No, man, I'm excited to continue the conversation. It'll be fun to kind of go through the rest of the material, and we'll get into the PenFin challenge that we talked about. That's really a spreadsheet that gives you a chance to look at sort of how you've been playing the game so far, see where you are in the process, how much have you made, how much have you saved, and sort of chart a course to say, based on where I'd like to go, how close am I to getting there? And we'll cover that in our next session.
All right, guys. So all these links are down below, and give us a like. If you got value from this, if you like the conversations that we're having like this, let us know what the engagement level is. Share this with your mortgage friends, and hope everybody has an awesome weekend. Mr. Ballenger, appreciate you, bro. And Mr. Bookspan, appreciate you. And Deborah, take care. This call is a wrap.
See you next week.